Right. Thank you very much, Kevin, and thank you again to Marine Money for inviting me back. This is a really interesting event to be a participant in last year, and I suppose it's sort of a positive or an unfortunate thing that shipping always stays interesting from year to year. So we've done a presentation today that's going to give a little bit of an outlook at some of the big macroeconomic themes that we think are impacting the world around ship financing, around global trade, how they're being impacted globally, and also how we feed them back from our perspective on the macroeconomic picture here in the region. So if you look at the kind of big projections for what's going to be happening in 2024, I think it's somewhat positive to say that the doom and gloom keeps being discounted further and further into the distance. Last year, everyone was really convinced they were going to have a massive recession in some of the big developed economies. In the end, it didn't turn out, as we had some very resilient consumers in markets like the United States, even in parts of the Eurozone and the UK as well. China was a little bit of a disappointment in terms of its recovery from the the very strict COVID restrictions. But looking ahead into this year, we're a couple months into it now, roughly the trend is for similar patterns of growth. So the big projections from the IMF are for growth of about slightly more than 3% this year, and much of that is being driven by emerging economies. I think what's really distinctive about this year, though, is that who's providing that growth is changing a little bit. So we've actually had some upgrades to the growth outlook for the United States, as it's showing some resilience to the impact of high interest rates. Markets in the emerging world, markets like India, are really taking the lead in terms of powering growth forward, whereas China looks a little bit more like a big question mark in terms of what kind of activity is going to be happening. The Middle East and Middle East and North African economies, I'll touch on a little bit more detail later on in the presentation, but they had been a big driver of the post-pandemic recovery and now starting to phase into a little bit more mature levels of growth. So if we look at some of the big markets that are powering the economy, in the United States, it's really been a story where we've seen a shift in patterns of investment and in consumption. It's not the story anymore where consumers are going out and buying goods, they're buying materials. We had that in the immediate aftermath of the COVID-19 pandemic. It's now much more a story around services. So we have seen a real slowdown in the level of manufacturing activity in the United States, in part reflecting that change in consumption patterns, but also, I think, responding to the fact that, hey, costs across the supply chain, no matter what industry you're in, are going to be higher. The cost of finance in your industry, no matter what industry you're in, that's going to be higher as well. So we've really seen manufacturing taking a back seat in terms of the economy there, and it's really down to services powering growth in the United States. In China, it's somewhat a similar story where we haven't really seen manufacturing providing the kind of historical style growth that we've seen in China in years gone by, and it is services there, but even so, the kind of post-COVID bounce that everybody was expecting turned out to be much more of a damp squib. I think consumers there are very reluctant about going out and spending, as the years of COVID really putting a dampener on their own investment and consumption plans, and also a relatively high debt burden for an economy as developed and mature as China's is. So that's really putting a bit more of a dampener on the construction atmosphere and environment in China. The major economic dynamic that I think is going to permeate across basically every industry, across every policymaker, across every sort of corporate boardroom, across a household, is what is the path forward for inflation. We've had really a once-in-a-generation inflation surge in the last several years. I've just got the chart here for the United States, but on the headline CPI index, that got up to over 9%. So these were really generationally high levels that I think consumers and probably this generation of corporate as well as financial market and central bank leadership had not had to deal with. Those interest rates or those inflation levels have been coming lower globally. We're seeing this trend basically repeated across all major economies, but it is taking a long time for that disinflationary trend to get closer to what central banks have as their target levels. So for the United States, the Federal Reserve targets 2% as a good level of of inflation to allow for growth in the economy. We're not quite there yet. The pace of disinflation does look like it's cooling down. And I think if you look at the inflation dynamics that we have in most economies since the pandemic compared with before it, we are in a much higher inflation paradigm. So even as the big spike in prices has started to fade out, if you look at the sort of cost of services, wages in many economies, they are much higher than they were in the period prior to the pandemic. And indeed, there's some issues in some economies, particularly like the Eurozone or the UK, where those wage increases have not been matched by productivity increases, which is sort of textbook economics equation for higher inflation to persist for a prolonged period. So if you have high inflation, what do you do about it? Well, central banks brought out the biggest sort of tool in their toolkit, which was raising interest rates. Again, I'm just focusing on the US as we feed through with the dollar rates into the region here through the currency pegs. But this trend, again, looks similar if you did it with the European Central Bank or the Bank of England, or indeed many of the other big developed economies, as well as emerging economies, which actually sort of jumped the gun on many of the developed market central banks and started hiking interest rates earlier. But we had about 525 basis points of hikes from the Fed since the start of January 2022, a very rapid hike in their interest rate environment. And the big question now is what's going to be happening with rates going forward for the rest of this year. If we had held the event on January 1st or sort of January 2nd, the chart on the right-hand side there, which shows you the market pricing for where interest rates are going, that would have said there was going to be about 6 interest rate cuts this year, 6 25 basis point cuts. That to us always looked like a very aspirational or very market-driven, market positioning kind of driven approach to interest rate cuts, rather than one that actually reflected the nature or the dynamic of the economy at play at the moment. So we had been a little bit more cautious in our outlook for rates this year, expecting at most 3 interest rate cuts. The market seemingly has been aligning to that, as the economic data that we've seen has been fairly positive so far, and the inflation trend is still lower, but it's taking longer to get lower. And actually, if I had updated this chart as of yesterday, the dotted line, which is the market implications for where rates are going, that's gone even higher, as we've had some Fed speakers who've come out in the last couple of days who've been pushing back even against the idea that we could have 3 cuts. You might have only as few as 1 in the second half of this year. Overall, I think the story for us is that interest rates are not going to be rushing down as quickly as markets would hope, or indeed as corporates would hope. So we're going to be persisting with a higher interest rate environment for longer. And even if we take this into 2025 and beyond, I think those issues around inflation and the fact that they could be exacerbated again by some of the policies being proposed by either administration or either potential administration in the US means that those rates are not going to be coming back to a zero lower bound range anytime soon. We're going to be in a much tighter interest rate environment for longer. And that's a trend that we think is going to persist pretty much across all major economies as well. I've got the chart here just for the European Central Bank, but again, showing a similar trend that markets continue to price up their trajectory for where rates are going to be going by the end of this year, now expecting at most a bit less than 4 interest rate cuts, or about 100 basis points of easing from the European Central Bank. Now, this debate as to which central bank will go first, who will go deeper, that is really what's going to be impacting what's happening in currency markets. We have had the US dollar hold on to some residual strength so far this year, as the data has been fairly positive and the US economy doesn't look like it's screaming out for interest rate cuts at this point, compared with, say, the Eurozone, where we have much softer levels of economic activity. But we do think that there is some room for the euro and sterling to start to appreciate a little bit by the end of the year, as when the Fed starts to cut interest rates, it sort of matters a little bit more than the Bank of England or the ECB. The markets sort of pay attention to it a little bit more. So we have that environment where you have a currency volatility, you have interest rates at a high level, you have a soft outlook for manufacturing and for sort of industrial demand. How does global trade play out in an environment like that? The chart I've got on the left-hand side is a very long-term look at manufactured goods and services trade as a share of global GDP since about the early 1980s. You can see from about 1985 just up to the global financial crisis, we went from about 30% of global GDP in manufactured goods to about 50%. So a massive increase in the contribution of goods trade to the global economy. Since then, however, the contribution of goods trade to the global economy has been a little bit more stagnant. We've seen quite a lot of leveling off. It has not been able to get back up to those kind of 50% of global GDP levels, and it's been fluctuating sort of in that kind of 50 to 40% range for the last couple of years. Services trade has followed a similar trend, although substantially smaller part of the global economy and taking a much bigger hit during the pandemic in 2020 as nobody was traveling. But it does look as though there is a character shift in global trade happening. And I think that's reflecting that we've had a less sort of optimistic or less sort of constructive attitudes around free trade. Many more questions about the benefits of globalization across developed markets and whether or not manufacturing should be re-domiciled or sort of done in a kind of friend-shoring or near-shoring way. The chart on the other side there, on the right-hand side, I've just constructed a barometer among the G20 economies to look at trade volumes across them. So their exports goods, basically as it gets to 100 on the positive side, basically all of the G20 countries are seeing an expansion in traded goods volumes. As it goes to negative 100, all of them are contracting in terms of trade volumes. So we've had some big swings in the last couple of years. Obviously, during the pandemic, a big slump initially on in the first half of 2020 and then recovering quite sharply. But as you can see, in the last, say, 18 months or so, we have seen a trend downwards in global trade in global trade across the big G20 economies, as we've had that shift in consumption patterns. Interestingly, though, that's not being matched by a parallel drop in the cost of moving goods around the world. So just the container freight benchmark I've got there on a year-on-year basis, that was declining, sort of leading into the drop that we had from the G20 goods, but we have had obviously a big spike upwards in the last couple of months owing to the supply disruptions from the Red Sea. Turning to a little bit on the focus on the region, we are seeing an impact of that feed through to the Middle East economies, particularly in Saudi Arabia, which is most acutely affected to the disruptions across the Red Sea. So supplier delivery times are extending, and that is weighing on consumer or on business confidence across the region. Overall, the big pass-through to the economies doesn't look like it's very meaningful yet, but I think it will be at these kind of marginal edges that the impact of the supply disruptions or the shipping disruptions are going to start to feed into the regional economy. Now, sticking with the region and our outlook for where oil markets are going in 2024, last year we had a very strong level of oil demand growth, really outpacing what anybody had been expecting, as you had solid levels of activity in economies like the United States, but you also had, despite somewhat disappointing headline GDP activity, a decent pickup in Chinese oil consumption this year, or in 2023. For 2024, the outlook is a little bit more muted. I think it's just given that we've had such a strong recovery last year, you're dealing with a much higher base, so you're not going to get the same kind of boost in oil consumption in 2024 that we had last year. We've also had most of the recovery take place in jet demand last year and in 2022. I've just got passenger kilometers measured as an index from the big Middle East airlines on the chart on the right-hand side there. So comparing with a 2018 to 19 average, you can see that most of them have essentially recovered all of the ground that they lost during the pandemic. So the gains here on out in terms of jet fuel consumption are going to be much more marginal, a bit more incremental. At the same time, we have a supply constraint picture, which is voluntary. So the OPEC plus countries are withholding production from the market. They've recently announced for some of those countries that had pledged deeper cuts for Q1 that they'd be extending them for the second quarter of this year for fear of adding back substantial volumes to the market, which could overwhelm oil markets and potentially lead to a price crash in a substantial way. So I think without the kind of supply discipline from the OPEC countries, we'd be dealing not in a sort of $80 to $85 Brent market range, but something much, much lower. Last year, we were also getting the market a little bit surprised by the surge in production from U.S. production, which really spiked to over 13 million barrels a day, hitting record high numbers. The outlook for that in 2024 is much more marginal. So you've seen a lot more supplier discipline there. There's not a big backlog of excess capacity in the industry in the United States that can be turned on quite quickly. So the growth outlook for the United States, we had about 1 million barrels a day added last year, is probably closer to 300 to 400,000 barrels a day. So a much more marginal increase. But that combination of this sort of supply constraint from OPEC that is still voluntary, but keeping a lot of spare capacity on the sidelines, incremental increases from producers like the U.S. as well as some others who are outside of the OPEC plus production bloc, combined with a relatively softer but still positive demand outlook, means that we think there's a fairly flat trajectory for oil prices this year. So for the Brent market, we're looking at an average of about $83 a barrel in 2024, basically flat on where we were last year. We have really sort of struggled to see much movement in oil prices since the start of the year. Occasionally we'll probably get spikes up or down around those kind of levels, but overall we see oil markets being relatively well supplied and relatively well insulated this year. Interestingly, it does look as though oil markets are proving pretty resistant to the escalation of geopolitical tensions across the region. The chart on the right-hand side there, some data from Bloomberg showing tankers as well as container vessels crossing Suez from south to north. We had seen most of the drop-off in container vessels rather than in tankers, although they did start to come off a little bit, although pulling back in recent weeks. Now, to look to the region, it's a fairly positive outlook in terms of how we see the GCC economies performing, although none of the growth is really going to be coming from the oil side as the countries are participating in those OPEC plus cuts. So if you look across the region for the non-oil growth story, numbers around 3.5% to 4% for the non-oil economies across the region, I think are fairly positive, and they're going to be driving growth for the next couple of years. We're seeing that even though interest rates have been high across the region, that inflation has picked up, although not quite to the same degree as we've seen in other developed markets. Overall business activity has been fairly positive. In fact, we just had PMI, Purchasing Manager Index numbers for the GCC economies released yesterday for February, and we actually saw a big or decent pickup from January to February, still very high levels of growth across the region. What's going to be driving that growth to a large degree, and I think this is true across both UAE as well as Saudi Arabia, is substantial government spending. So if you look at private sector spending, public sector spending in UAE out to 2030, it's about $200 billion of capital expenditure that is on the books or is currently underway, and across multiple industries, energy, utilities, transport, logistics, construction, all of them seeing the benefit of additional government spending. We've just got a bit of a lumpy cash flow curve from the government spending over the next couple of years. A lot of that spending will be in the middle of those projects from about 2024 to 2027, that kind of time frame. So that's where we're going to see sort of the bulk of that spending coming into the economy. But beyond just the domestic story for the UAE, one thing that we're noting with some considerable strength that the UAE is pushing is a very different sort of trading mindset, I think, than many other economies are facing at the moment. If you look at, for instance, the United States, I think no matter who wins the election in November, it's probably fair to say that 2025 is going to be a U.S. economy that is imposing more trade restrictions rather than fewer. The UAE is bucking that trend and going much in the opposite direction and forming more and more comprehensive economic partnership agreements with economies around the world and in vastly different geographies, trying to make sure it is well insulated and has a diverse set of suppliers and export markets. This helps to build some sustainability and resilience in their own supply chains, as well as a bit more sustainable growth going forward on a long-term basis. And then finally, the sort of not quite the elephant in the room, but is Saudi Arabia. Substantial economic transformation program underway. We estimate that there's actually closer to about $1 trillion of planned spending as the economy goes through a whole of economy transformation, building out logistics, building out massive construction programs in the kingdom across multiple sectors, all of which are going to require intensive applications of heavy capital inputs, construction, manufacturing, as well as more domestication of manufacturing in the kingdom as well. So far, only about $60 billion of those targeted investments have been actually committed to or actually underway at this time. So there's substantial room to be continuing to invest and take advantage of the opportunities in Saudi Arabia. And with that, I think I've managed to get in just under time, so I'll hold my presentation there and happy to take any questions if there's any from the floor. Thank you very much.
Yep. Any questions, please, for Edward? Yes? No? No? Yes, sir.
Just a clarification. You had transportation for the GCC or for the UAE and construction. So where do roads come in? Roads, is that part of construction or part of transportation? Because that's the highest, transportation the highest on your slide.
Good question. The transportation number largely is down to airports. So the Abu Dhabi airport sort of improvement and expansion program, that's sort of sucking in most of the expansion there. Actual investment into roads, I'd have to check actually where that lands in. My hunch would be it would be part of the sort of transportation infrastructure type bucket rather than construction, which relate more to housing and commercial real estate projects.
Okay, thank you. Another question, please? No, just give me just a quick one from me. I mean, on the whole thing, oil and gas thing, I mean, you know, oil and gas has been the kind of staple of the region for the last, for a period of time. Going forward, how is that kind of balance going to change between oil and gas and everything else that's happening?
Yeah, well, interestingly, already if you look at the 2023 GDP numbers for Abu Dhabi Emirates, the non-oil sector is a larger part of the economy than the oil sector is now. So there has been, if you look at the UAE in detail, tremendous success in the economic diversification away from oil and gas as far as we can measure it in terms of the contribution of GDP. Saudi Arabia is a little bit behind on that journey, but certainly the kinds of investments, the sectors that it's investing into, I mean, I think we sort of get caught up into Saudi Arabia spending money on football players. But that's not the only thing that's being spent on. Manufacturing, metals and mining, all of those sectors are also receiving substantial investments. So the economic diversification from a GDP perspective is progressing very strongly, and that allows a little bit more resilience to the economies, to the volatility that we see in oil and gas prices. Where probably there needs to be some more work on diversification is where governments and where the economy sort of generate their income. So if you look at the fiscal breakdown, you're still talking about 90% plus across the region generated from oil and gas taxation, essentially, from the national oil companies. If you look at it from the current account balances, overwhelmingly dominated still by hydrocarbon exports, whether that's crude oil or products or something related to those industries. So as more and more of the non-oil economy develops, that'll allow for those non-oil exports to take a bigger share of the export basket of the region and help to insulate them again a little bit more from the volatility we see in prices. If you look at UAE in particular, you actually now have a trade surplus in services exports. So we actually now export more services, largely in the form of tourism, than we do import sort of banker or lawyer fees from London, as had been the case historically.
Perfect. Edward, thank you very much.
Thank you.